All right, I want to take a look at some long-term trends in today's video, and I'm going to start off with interest rates. We've been in a bear market for interest rates, a bull market for bond prices, for almost 40 years now. And I think at that 4-year cycle low back in March of last year, that was a 4-year cycle low in the stock market. I think some major trend changes occurred um, in several markets. For one, I think this is probably going to end up being a final bear market bottom in interest rates. Now, that being said, it's not unusual to have a retest, and bond prices, it would be a double top. Interest rates, it would be a double bottom. So, we've had a nice rally in interest rates since that bottom in March of last year, but I think at some point here, and especially since we've had kind of this panic sell-off in bonds over the last several weeks, I think there's a good chance that that interest rates top here pretty soon. Maybe they get to 2%. But then I think they're going to have to come back down and retest this low, and maybe even churn around this level for a while before they actually turn and start a sustained move that confirms that this bear market in interest rates is over. All right, so I think that bear market, at the end of the bear market in bonds, is signaling that we're starting an inflationary phase. And if I look at the chart here of the CRB, I think this would confirm that. You can see our last commodities bull market ended in 2008. We had a massive inflationary phase. That was one of the main contributing factors to the severity of the recession that occurred in 2008 and into 2009. And then we started a secular bear market in commodities. And that final collapse into that March low, which coincided with the stock market crash, I think we've put in a final bear market bottom in commodities, and I think we're starting a new inflationary phase. We're getting pretty close to a resistance level here, so we haven't had much of a correction. We had a kind of a sideways period right in here, but once we may have one more run higher, and I went over this a little bit in the weekend report for subscribers, but we may have one more little run higher to come up and fully test this pivot right here, which would be a significant resistance zone. And then we may get a more significant correction in commodities at that point. All right, now moving on to oil. I've mentioned this before. The markets kind of work like a pendulum. I call it the rubber band theory. The further price gets stretched away from the mean, the more violent and aggressive the reaction tends to be when the selling or buying pressure is released, and then the market moves in the other direction. You can see that, really clearly here at this bubble top back in 2008. Price had just gotten stretched insanely far to the upside, and that unleashed a serious crash. And then we entered this long-term bear market, and then we had another crash into that March bottom, where stocks, commodities, oil, gold, everything got hit. And so the pendulum swung really far in the downward direction here, below $10, and actually for a brief time, oil was trading negative. You could get paid to take oil, and so we've pulled the rubber band really far to the downside, and that based on the rubber band theory, that should ignite a really strong move to the upside, and you can see that's exactly what's happening here. Oil has kind of moved up into this resistance zone right here. We've had a bit of a pullback. I think that's just going to be a temporary pullback, and we may have to go here to this next resistance zone around 75 to 77 before we get a more significant intermediate decline, something that's going to last more than 1 or 2 weeks. But the big picture, I think, is pretty clear. I'm pretty sure this is a final bear market bottom. We've wiped out all the excesses from this bull market, from this bubble. We've spent almost 13 years working off this bubble, and I think we've got a final bottom here, and I think we're starting an inflationary phase. And the obsession with this climate change and the green energy is only going to exacerbate this. I think we're going to make, and we are making, really stupid, irrational decisions about energy. And so, in the next over the next 5 years, 10 years, I think we're going to see oil back up here to 150 again, and maybe as high as 200 during this next bull market. But we are getting close to a major resistance zone in here that might trigger a multi-week pullback, something that could run for 6 to 8 weeks. But I don't think we're ready for that quite yet. I think the pullback we've had right now is just a temporary daily cycle low, and we may have to have one more push up before we get that longer corrective move. But the big picture is I'm very confident we've started an inflationary phase again. And now for a look at the stock market, and I've covered this multiple times before. The crash in March, I think, was the slingshot move, got everybody on the wrong side of the boat. And then that's what is powering what I believe is the final bubble phase of this bull market. I don't think that the top is here at 14,000. I think we've got further to go. I think this is just our first volatility event during the second phase of the bubble, and that's what I would characterize this right here as we broke out of this period where price was going up in a controlled fashion, and then we just got completely irrational. There was a couple of volatility events along the way in here where big corrections of 12 to 14% occurring in a very short period of time before the final advance, and I think that's what we're at right now. I think we're pretty mature in the volatility event. I think we're getting ready to exit that soon. But again, if we apply the rubber band theory, price is getting stretched very, very far above this long-term 200-week moving average. And if we do get our second leg up, which I don't think 18 or even 20,000 is out of the question, I think we're going to be setting up for a gigantic crash that should come well below this 200-week moving average before we're done. I would say, a test of this top here at 5,000 would definitely be in the cards, and probably likely, and maybe even a little lower than that. But we're setting the stage for a massive, massive crash. But I just don't think the bubble has topped yet. I think it's got further to go. I think we're going to stretch it even further and make that crash even more catastrophic when it comes. And I think that'll unleash a depression, maybe of the same magnitude as it happened in the 30s when that occurs. And if we're still trying to sabotage the energy sector, then it'll just make it even worse. And then finally, a quick look at gold. As I've said before, gold is leading this commodity bull market. When everything else, was crashing in March, gold was, holding solid above 14,000 or 1,400 and close to 1,500. It had already started the upward advance in this what looks to be a cup and handle pattern. At the top here at 2100, gold had gotten stretched quite far above this 200-week moving average, so we were going to need some kind of corrective move, and it's probably lasted a little longer than it, I would have anticipated. I think naturally, probably 1800 would have stopped this decline naturally, but as I've said before, the banking cartel had a lot of shorts they need to get out of, so um, not unusual, and we're doing what we need to do. We're closing some of this gap with this long-term moving average, and we're setting the stage for the next leg up. So I think we may be pretty close to a final bottom here as well. We've certainly got a daily cycle low in the gold and the mining stocks, and I'll need to see just a little bit more, but I'm cautiously optimistic that this may also be an intermediate cycle low, and if that's the case, then we should start advancing higher and breaking out of the handle of this large cup and handle pattern. Now, it may not be an easy move up. We've done a lot of technical damage during this decline. We went back through this support level, which I kind of knew we were going to do, but I really didn't think gold would naturally move below 1800, and it has, and we're down to 1700, but we didn't get any sustain to move below 1700, at least not at this point. And then I'll end with a quick look at the gold oil ratio. You can see during the crash, everything got hit really hard, including gold, but gold a lot less than everything else. Gold is already anticipating the inflationary phase. It's leading the commodity bull market. And so you see that huge spike in the gold oil ratio. It took over 100 barrels of oil to buy 1 ounce of gold. And that has been correcting. Oil has been rallying very strongly, and gold has been in a correction mode since August of this past year. That ratio has come back down to tag the 200-week moving average. So we've eliminated this massive stretch to the upside. And as I said, I think oil may have a little bit further to go, but not too much further before we get a much larger degree and more sustained correction. And then I think that will coincide with gold starting to break out of that handle correction, and we'll get another push up in this gold oil ratio as the leaders switch again, and gold resumes its leadership role in the commodity bull market.